Today we are going to talk about investing in the market at all-time highs. This is a very timely topic as markets have crested new all-time highs, depending on which index you're looking at, several times in the last few weeks. Just last week, the S&P 500, there was news stories that it hit an intraday high of 5,000, which was a new high water mark and crossing that 5,000 mark. So a lot of questions that I get from folks are, with markets at all-time highs, does it make sense to continue to invest? Should I wait until that market drops? Does it make sense to go to cash? What people get a little bit skittish at these all-time highs. So I just wanted to record an episode to discuss why a continued disciplined investment strategy when the market is at all-time highs is very prudent and backed by data. So let's get into it. So all-time highs, the overarching theme here is all-time highs lead to more all-time highs. So all-time highs beget more all-time highs. Some data that I'll link these in the show notes, but this is from the Wealth of Common Sense. They put an article out last week talking about some data that was put together by JP Chase. Some unbelievable statistics here. I'll just read these out for you. So since 1950, there have been new all-time highs on 6.7% of all trading days. Okay, 6.7% of all trading days. So if there's 250 trading days, we're talking new all-time highs on something like 14 days a year, every single year, okay? In the 1990s, it was more than 12% of all trading days. After the 1929 highs were finally taken out in 1954, there was a new high in one of every 10 trading days for the remainder of that decade. From 2013 to 2019, this was a huge bull market, right? We had new all-time highs on 14% of all trading days. And then this decade, despite two bear markets, the S&P 500 has hit new all-time highs on 11% of all trading days in the 2020s, so in the last 4 years. So anywhere from 6 to 12, 14%, we've had new all-time highs, depending on every single trading day, somewhere between 6 and 14%, depending on which decade you're investing in. That is unbelievable data and just backs up that we want to continue investing. Even though markets are at all-time highs, it's very counterintuitive. You think you might want to wait, but all-time highs continue to happen, year over year, over year, over year. And we want to continue to ride that bus. We don't want to jump off because all the data shows us that would be not a very prudent thing to do. Some other data from JP they found if you invested in the S&P 500 on any given day since 1988, your average total return a year later would be just shy of 12%. However, if you invested on days where the S&P 500 closed at an all-time high, right? So that would be S&P 500 just crested 5,000. There's another all-time high. Your average total return would be nearly 15%. So if you just tried to time the market when we are at all-time highs and only be investing on those days versus investing on any given day, you would actually see a higher return since 1988. Again, this backs up exactly what we see in all of this data. Investing at all-time highs, you should be really excited about it. This should not be a scary thing. In the short term, we don't know. We can't predict. The market could be down 20% next week, but on average, the data shows us all-time highs are a good thing. Another graphic that I will put in the show notes is one from Dimensional Fund Advisors. They took some data from 1926 to 2022 of the S&P 500, and they basically said, hey, if we invest after months that ended at a record high or after months that ended at any level, so consistent investment, the 1-year returns on that money for the investing at all-time high would be 13.7%. Investing anytime would be 12.4%. So we're seeing that all-time highs beget more all-time highs right there. 3 years later, those returns are 10.6 and 10.7% respectively. So about the same. And 5 years later, they are 10.2 and 10.3% respectively. So we're seeing over long periods of time, over the short term, all-time highs beget more all-time highs. We can expect that market on average is going to continue to make all-time highs. And then over the long term, you would think that eventually the markets will drop and your returns are going to drop, but we're seeing the opposite. Returns are holding steady when compared to investing at any given level. So all that data kind of brings us to the conclusion. We should be really excited about all-time highs. It's a great thing, right? Looking at your portfolio is fun when there's all-time highs, but we shouldn't if it's long-term money and we're true disciplined long-term investors, we should not be scared now to continue to invest, to continue to put into our 401k or TSP, our Roth IRAs, our taxable brokerage account, whatever it may be. All-time highs are temporary until there's new all-time highs. And all the data that I just presented today shows us that it is a prudent thing to be investing when the market's at an all-time high. If you wait, we have to be right a couple times, right? We have to wait. We have to know, okay, if the market drops 10%, is it now do I invest? And then what if it keeps dropping? Do I get out? Like, you have to be right several times if you're going to play this market timing game. It's a beautiful thing, I think, that the best strategy per the data is to continue to invest in the market, even though there's all-time highs. If the data showed that jumping in and out of the market was a good thing and we could do it, that would be much more complicated, and it would put a lot more pressure and anxiety on investors. The fact that we can continue to know that we're doing the right thing and continue to invest when markets are at all-time highs is, I think that makes me sleep well at night. Like that makes me believe in markets. It makes me not have to think as much. If I've got long-term money, I know that continuing to put that in the market is a prudent thing to do, and that's what the data is showing me. With any short-term money though, like if we're saving for, I will say a caveat, if we're saving for a down payment on a house, we've got 60, we've got 50 grand, 100 grand, whatever it may be, maybe in a high yield savings account. Putting that in the stock market, if we're using that money in the next 3 years or so, it is not a prudent thing to do, right? When I say continue to invest in the market at all-time highs, I'm talking about that long-term money, that retirement money, that 10, 20, 30, 40 plus year money. We should sleep well at night knowing that continuing to put that in the market is a good decision. So that's all I have today. Thank you for being here. Continue to invest at all-time highs, and let me know if you have any questions. Thanks.